Hey there, my name is Linda Keith. I'm the Chief Credit Trainer at Lenders Online Training, where we help lenders and analysts and underwriters say yes to good loans. And I guess the reverse of that is say no to the bad ones. I am joined by David Stoffaker, one of our senior credit trainers. Hello, David.
Hello.
Hi. So today the question is, what difference does cash versus accrual make? And it's such an important question that we actually look at whether it's cash versus accrual before we even start in on the numbers. And we train our lenders and analysts to do that as well. Now, this is in our K-1 and pass-through series, but really the cash versus accrual understanding impacts 1040 filers, and frankly, even in our financial statement analysis class, which focuses on financial statements, cash versus accrual is a critical topic. So we're going to start with the basics. David, what is the basic definition of cash versus accrual basis?
All right, the basics, the fundamentals as I look at the definition. Let's just think of it from a cash basis is we record income when the funds are actually received. When I've got that check, when I've got that money and I put it in the bank, that begins the transaction. Now, the expenses are likewise, right? When I write the check, I give the check, that is the emphasis of when it's occurred. So think of it as, can I bring up the word checkbook? Do we still use checkbooks nowadays?
Yes, I'm not even sure we use the word deposit because really they're just doing electronic transfers, but let's just pretend old school deposits, checkbooks. Sure.
I'll be old school when I was a banker, but yes, think of it as a checkbook as those transactions. Once they're recorded, that's what we show on our records. So what is the advantage of it? First of all, it's pretty simple, right? We're adding and we're subtracting. We don't have to mess with timing issues. Now, the advantage to the business is a tax-related discussion. It actually defers the income by the time I receive the money. That may be into the next year. So the deferment of taxes, and that's good for a growing company, right? As they're growing up specifically, we've got a lot of receivables. We actually defer that actual income. Now, there on the flip side, there's probably a disadvantage with regards to that. It definitely can be misleading when you're trying to, evaluate a customer. Our farmer situation, some days there's going to be evolutions as far as what happened 1 year to the next, and it does distort our understanding. So we have to be cautious when we're looking at cash basis statements. And heaven forbid you mix cash basis statements with accruals. I've had that situation come up in some loan committees. And I said, guys, ladies, we're mixing apples and oranges here. This doesn't necessarily work. So let's go to accrual basis, the other side. Now, this is a little bit different in the sense we actually record the funds when it's earned. When there's what I would say a transfer of the ownership of the item, when we sell something, that's when we're in invoicing, that's when we're going to actually show that is earned. Now, the expenses will be obligated at that time. They are matched with that item as it goes through. So it's more of a matching principles. We'll get to the issue of GAAP in a minute, but that's the advantages to we kind of understand the business better. I prefer accrual. I get to understand the ebbs and flows of the business, how it operates, how the cash flow of that business is. There's no misunderstanding. There's no hidden items that I just don't know about it. I think understanding accrual helps me project or helps any client understand where they're going a little bit because it is encompassing of all the accounts that we have with regards to the company. I think it's, from my perspective, I do a lot of consulting with clients. It gives meaningful conversations. I can talk about certain things or have them explain to me certain operational issues and how they're growing, how it impacts their cash cycle as a business. And quite honestly, for strategic planning purposes, it is a great method of evaluating your finance of all the activities that you're doing. We talk about forecasting, but what is the true impact of cash flow? We know that the cash basis is a checking account, but there's other things that are going on there that might impact our overall cash flow of a business. Now, the disadvantage of accruals, well, in a growing company, you might be paying taxes on stuff that you haven't received the money yet. It's sitting in accounts receivable, but you're paying tax on it because it's earned. And I think you kind of require a kind of that accounting knowledge, that CPA, because there's a lot of moving parts that are associated with this. So Linda, why do we teach lenders here at Lenders Online Training, analysts, underwriters, why do we teach them to understand the difference between cash basis and accrual before they actually get into these numbers of tax returns and financial statements?
Well, let me tell you a story, David, which I often like to do from my own experience because truly so much has happened to me. So in this case, this was a time when I was doing a lot of in-person training directly at banks, credit unions, but also through banking associations. I had cash basis tax returns. And there's really two morals of the story. One is when I realized what it looked like, it kind of threw me because your borrowers don't pay attention really to what the tax return looks like. So if you say to them, whoa, business is down because revenue is down, and they look at you like, what? Because it's not down, they have higher receivables, they've done all this work. So in their brain, they know business is up, and you, their lender, is saying, oh, business is down, and they're thinking, you don't know what you're talking about. I don't understand you. You don't understand me. So that's one of the problems with cash basis, is that it actually can lead to a conclusion that we do not have any basis to make. Business is down or up just because revenue is up or down, or other expenses are moving that way as well. So here's the example. I scheduled quite a bit of training with Oregon Bankers Association towards the end of that year. And at that time, I got a 50% upfront payment on training fees when we signed the contract. Very standard in training and speaking businesses. Well, so that year, at the end of the year, I happened to have received more deposits than I usually do. Cash basis, what does it look like? Revenue is up. Now, if it had been the same amount of deposits as the last year, it actually would have looked even, right? But if it was an unusually high amount of deposits on hand, revenue is up. And then what happened, David, next year? I receive all these funds. I'm back to normal amount of deposits. Cash basis, though, they didn't show up in that second year. They'd already shown up in the year before. So business was here, then it is up, then it's down here. And it really wasn't. Earnings were actually pretty stable. It just looked like that because it was cash basis. And in fact, we went in, my husband was in construction at the time. We went in for an update on a line of credit. Our construction lender takes a look at our tax returns and immediately says, Linda, what's going on? And that was a reasonable question, because even though she knew to look that it was cash basis, you still can't tell why if you don't see a balance sheet there and if it's not required. So she asked what was going on. I explained it to her, and here's what she did. And I suggest this for those of you listening to this live stream, if this happens to you. What she said was, Linda, that's very helpful information. Would you write me a letter that goes along with your request on the line of credit and just lay out what you just told me about the extra deposits in 1 year and so forth? Here's what she did. Number one, have you ever had this happen where you are having a conversation with the borrower or the prospective borrower? Everything they says is making sense, but you're thinking, how will I ever restate this in my write-up? Right? How will I explain all of what they just said to me? Don't try. Have them put it in writing, and you get two things now. You get the explanation that apparently was important to you, that you thought was important for your judgment call, but then they sign the letter. The reason we get tax returns instead of just financial statements for small to mid-sized businesses is they sign the tax return, right? So what I did in that letter, David would know this, I essentially turned my cash basis statements into accrual basis in narrative. And it showed what was going on. And she was familiar enough with my business. I was not new to her. She was familiar enough with my business. And frankly, we had a relationship of trust built up over the years that she was confident using that information. So that's why you want to see if it's cash or accrual beforehand, so you don't jump to conclusions that are unwarranted, and instead ask the question, oh, it looks like revenue's up and down, but I see your cash basis. What's actually happening? And you've just, number one, won a lot of points because you haven't made an assumption that your borrower is immediately thinking, what are they even talking about? So that is that whole cash versus accrual and an actual practical explanation of it. So David asked me, why do we look at it beforehand? Well, that's exactly why. We need to understand that cash basis will present differently than accrual basis. What we say in our training is, if they're writing on their handouts, we say, be careful comparing the years, right? You see cash basis, be cautious comparing the years and jumping to conclusions. Now, if it is accrual basis, then you do have the ability to look at those balance sheets, which happens to be kind of David's favorite thing. You can see what's happening with liquidity, what's happening with receivables, what's happening with payables. So even though you've got better information on earnings, if you're focused on cash flow, you can start spotting cash flow issues in the balance sheet. So we're going to see cash basis most of the time with these small to mid-sized businesses. No one ever came to me when I was in public accounting and said, Linda, we would like to pay taxes sooner than later. It never happened, right? So we are going to see a cash basis a lot. You are going to want to notice which it is. Be careful comparing the years, and instead ask some questions if it appears that they are all over the place, because you cannot tell by looking. So let's see. Even with cash basis returns, I kind of alluded to it, but I'd like David to key in on this. Where do we find that accrual basis information, even if the tax return itself is done on the cash basis?
You know, what's interesting, Linda, when we're looking at the tax return, we are in a way mixing both methodologies, because we have cash basis most of the times on the front part of the income source, but there's also the accrual side. We go to one of the schedules, Schedule L, as you mentioned before, that's the balance sheet. You know what that is? That's based on books, per books and records. So that's what's interesting. And so they do have accounts receivable. They do have accounts payable. So you actually can do a little bit of analysis on that balance sheet based on the accrual methodology, because there is some, the changes in those operating accounts will impact your overall cash from beginning of the year or beginning of the period to the end. So that's very important for us for analytical purposes, or for lenders. We can get a feel for kind of their operating cycle, if they might need a cash, they might need an operating line of credit, or if we know that things are growing, it may raise an eyebrow. So I think as lenders, when we look at this, and we have a weekly talk, one of my talks during our sessions with Lenders Online Training, I talk specifically about the balance sheet. I also talk about red flags and looking at what happens from one period, beginning and period to the end. What I like about the balance sheet in the tax returns, it actually shows the beginning of the period and at the end of the period. So you kind of got two balance sheets right there together to do the analysis, which I find very enjoyable, because you can look at the analysis, and we will work with our participants, our lenders, and say, all right, look at those. What items seem to be unusual, or something that may just kind of raise your eyebrow and make you pause, or maybe ask a question? We think of those as maybe red flags, and we have an opportunity to start a conversation or learn more about the business, or get the perspective of the borrower, what's going on, something that we just may not know about, and there's a simple explanation. Now, with regards to the balance sheet, we do have to be careful. There are occasions where you may not see this Schedule L filled out. That seems strange, right? If they have a balance sheet or not. Well, if we looked at Schedule B, which is one of my first go-tos when I'm looking at tax returns, there are some limitations on that with regards to certain levels of revenue and asset size that, a business, if it's under a certain level, they don't have to report a balance sheet. So be cautious about that. We don't want to reach out to maybe the CPA or the bookkeeper, tax professional, and say, hey, I didn't get this tax return doesn't have a balance sheet in it. Did you make a mistake? We just want to make sure that, quite honestly, they don't have to fill one out. So just be aware of that on Schedule B. It'll let you know if their assets are above a certain level or not. The last thing to emphasize in Lenders Online Training, we always talk about analyzing all the forms, all the schedules that we have, to see which ones are required and which ones are not. And we had one of our live stream talks that really got into all the different schedules and which ones we felt were very necessary to look at and look for versus not that are important. So you may want to check that out as well. But there are some that may not be useful for us or not included. Linda?
And then there's some that are never useful, never included, ever. And it is important when you're starting out to be comfortable with ignoring whole schedules, whole forms. In that live stream where we went schedule by schedule, Schedule B in these pass-throughs is where you'll see cash versus accrual. It's where you'll see what kind of business it is, as well as David mentioned, do they even have to have a balance sheet? So important to know what's important there. And I don't know how many questions are on Schedule B. I only care about, I think it's 4 out of 20 or so. So there's a lot of information there, as always, that tax preparers need to know, but lenders don't. And we need to get through the weeds and find the ones we care about. All right, well, so we do have a module on cash versus accrual in the getting started section of our courses. It's there because it applies both to tax return analysis and to financial statement analysis. So that's lendersonlinetraining.com. And I want to tell you about a guy I was talking with this week. He came into a new position, new bank. His experience at this other bank was he was primarily the relationship manager, the prospector. He is really good at finding and talking to business owners and looking at opportunities. But at that bank, he had an underwriter or analyst who then took the file and did all this analysis. He's now with a bank where it's what I call cradle to grave, right? You go get the deal, you underwrite it, you present it to loan committee. If it goes bad, you have to explain to loan committee why it did and come up with a restructure. It's the whole piece. And he finds that he's really good at that first part, and he feels like he needs to shore up that analysis number crunching. That's actually one of the use cases for Lenders Online Training. In addition to market hires or college hires, it's when somebody shifts. Maybe it's shifting from one type of lending to another. And when they shift, they need to shore up whatever they're short on. All right, so lendersonlinetraining.com/talk is where anyone can call, whether an individual or for your team, talk to us about doing foundational training for your folks. And then when I stop talking, Suzanne will put up a slide with that URL. She also will have on there experts at lendersonlinetraining.com, which is where you can ask any question you have, which informs our live streams, and our Ask the Experts subscription, which also you can sign up for. Email once a week. Subject line gives you the question, so you can decide, is that something I need more on? So even once you have your foundational training, or maybe you are one of the experts at your financial institution on tax return analysis, I'm guessing there are some black holes. I'm guessing there are some gaps. And in fact, this whole series on K-1s and pass-throughs is designed to plug the holes in your understanding when it comes to more complex tax returns. That's it for the weeks. Thank you so much, and we will see you again. Take care.